Good afternoon and welcome to HYROX's weekly webinar where we're going to talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. Now, we invest our money in the exact same models as our clients, and we think that this is really important. We are eating our own cooking, as it were. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HYROX, who, by the way, has done some great bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year, continuing to add value to our models and portfolios while at the same time reducing our exposure to risk. Our financial planner and well forecast specialist, Bianca Tomlinson, is also on the call. A special birthday shout out to Bianca today. Happy birthday, B. We will have a question and answer period at the end of the call, so if anyone on the call has a question about any aspect of wealth management, we invite you to feel free to ask us questions. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client tab. Well, as we do for each webinar, let's quickly recap our themes for 2016 before we get started on what happened since we last talked. I have been told that I am not so quick when I recap, so I have tried to rein it in a bit. But as you all well know by now, our overall and overriding theme for 2016 is that financial markets will remain volatile. Volatility bounced back last week as uncertainty levels rose. As I suggested on BNN last week, we think that the risk of a recession in the U.S. is high and rising. More on this a bit later in the program. Low inflation and deflationary pressures continue on a global scale despite the efforts of central banks to mitigate them. And extraordinarily stimulative central bank monetary policy on its own has not succeeded in reigniting economic growth, and now central banks are revisiting their options. Well, first Brexit and then the rise of populism in developed nations, now the U.S. presidential election, add in North Korea, Russian influence, and terrorism, which are all having an impact on the consumer, business, and investor psychology. Bond markets are in a state of flux as investors try to ascertain some direction, but that will not be likely until we hear from the U.S. Federal Reserve next week. Equity market prices had been comforted by central bank monetary policy stimulus, but showed their vulnerability over the course of the last week. We are in a time when the risk-free rate of return is dangerously close to 0%, which means that to try to get higher returns, investors have been taking on more risk. We think that this makes for a precarious situation for investing and that caution should be the order of the day. Last week was a case in point. Okay, well, speaking of last week, let's have a look at what's been driving markets. As we had anticipated, volatility has returned. And this is how volatility looks relative to recessions in the U.S. in the past. Volatility certainly gets elevated, but is probably no surprise to anyone. With higher uncertainty comes more fear, and that's what brings volatility. And this is what we had been suggesting would happen based on our past experience, and this is what has happened. We think that there might be more fear to come as we move forward. Since our last webinar, our benchmark World Equity Index is lower by 3.5%, up by only 3% now on the year. Switzerland's SMI index was the best performer over the course of the last week, and once again, Australia's All Ordinaries Index was the worst performer. This has been about the fourth week in a row that the Australian index has been lower. The Canadian TSX has been the best performing country index in the developed world this year. China's Shanghai Composite has been the worst performing index this year. The broad and diversified benchmark equity index upon which we gauge the performance of our model and portfolio performance covers close to 25 companies domiciled in 23 developed countries and 23 developing countries and covers 10 economic sectors. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. While unable to find follow-through buying, our benchmark index sold off last week because volatility picked up and uncertain investors scrambled to move out of riskier assets. Failure to see buying at these lower levels means that there could be further price exploration to the downside. The greater than 3% correction over the last week pushed the year-to-date total return down to 5%, the 1 year to 7%, the 3 year to just under 5%, and the 5 year return to 9.5%. And if you combine the equity and bond indices into a balanced scenario and allow for fees and MER costs, the total return for a 60% equity and 40% bond index combination year to date is 3.67%. 1 year, about 4 3/4, a little over 4% for 3 years, and just a little over 6% over the 5 year term. For the less risky 40% equity, 60% fixed income, the year-to-date return after fees and costs, 3.4%, 4.18 for 1 year, about 4 1/4 for 3 years, and just a little under 5% for the 5 year term. By comparison, a client who started with us in January has a total return this year to date after fees and costs of 6.06%, nicely ahead of that benchmark, which is at 3.67%. Interestingly, last week this portfolio was up 6.33% on the year after fees and costs, so it's now down about 1/4 of 1%. The benchmark, fully invested, allowing for fees and costs, was up by 5.5% year-to-date last week, but after all the volatility, lost about 2% on this week's on the volatility this week. But our more conservatively invested portfolio actually gave back very little on a relative basis, and this is how and why we build our portfolios the way we do, to capture growth and to retain it. Very important to us. After the after fees and costs 1 year performance of a 60/40 HIROC client is about a 5.5% return compared to the benchmark at about 4 3/4, while the 3 year performance of 788 is well ahead of the 4.08% return of the benchmark. I must also remind all of our listeners, and I'm sure that you're all very aware of this, that historical returns are in no way a guarantee of future returns, although at HIROC we do work very hard to try to get the very best possible risk-adjusted returns for our clients and ourselves at all times. Well, all bonds dropped this week except for Canadian high yield. Canadian fixed reset preferred share market has been the worst performing of the fixed income assets this year. We have in the past often talked about how Canadian high yield bonds have low correlations to other financial markets. It is interesting to see how through all the volatility in financial markets over the last week, the HIROC Canadian High Yield Bond Fund, both the exchange traded closed-end fund price and net asset value, had no volatility whatsoever. Now, in full disclosure, HIROC is the manager of this particular fund. Natural gas was higher in the world of commodities. Gold was lower. And oil, which bounced off that $40 area a few weeks ago, has struggled to get back towards that $50 level, although it remains in its uptrend from the February lows. Now, today, according to the International Energy Agency, a surplus in global oil markets will last for longer than previously thought, persisting into late 2017 as demand growth has slumped and supply proves resilient. World oil stockpiles will continue to accumulate through 2017, a fourth consecutive year of oversupply according to the IEA. Consumption growth sagged to a 2-year low in the third quarter as demand faltered in China and India, while record output from OPEC's Gulf members is compounding the glut. Just last month, the agency predicted the market would return to equilibrium this year. Commodity prices have broken down through the bottom of their recent upward trend channel, so we have to keep an eye on that. And the Canadian dollar, following oil prices lower over the last little bit. Well, the U.S. represents more than 20% of the global economy, and with over 50% of the companies in our benchmark X index domiciled in the U.S., we keep a close eye on what's happening in the U.S. economy. Almost 70% of the U.S. economy dependent on the consumer. It is important for the consumer to remain confident. When consumers are uncertain, they will postpone spending. When businesses are uncertain, they will postpone investing. And this makes it a tough environment for economic growth, which in turn makes it difficult for corporate earnings to grow. Well, the U.S. presidential election is one of those factors causing plenty of uncertainty and will likely cause more of it as we approach Election Day on Tuesday, November the 8th. For the moment, Clinton's health issues have taken center stage, and she has lost some ground to Trump. Now, uncertainty surrounding Trump's attitude toward the U.S. Federal Reserve and its chair, Janet Yellen, will certainly create concern among financial market participants. It is unconventional for presidential candidates to politicize monetary policy, but there is certainly nothing conventional about Donald Trump, and this will play further into the fears of financial markets. Not just financial markets, but the mainstream economy is also suffering the election uncertainty. Businesses are reluctant to invest, and historically, 5 of the last 11 recessions have followed elections. So a little bit of more interesting stuff to add to our radar screen with regards to the U.S. Recession that we actually believe is not that far off. And as we've talked about on our Recession Watch radar screen, and something I talked about with my discussions on BNN last week, is that this 3-year moving average unemployment rate is now converging on the current unemployment rate at a faster pace. And at this pace, in a few more months, they will intersect. Now, historically, when they intersect, the recession tends to follow. Interestingly, how that ties in with the approximate timing of the U.S. presidential election. Now, according to the Wall Street Journal's John Hilsenrath, Federal Reserve officials, lacking a strong consensus for action a week before their next policy meeting, are leaning toward waiting until late in the year before raising short-term interest rates. The Fed's decision has become the subject of intense market speculation over the course of the last week. It is a close call, but with inflation holding below the Fed's 2% target and the unemployment rate little changed in recent months, senior officials feel little sense of urgency about moving and an inclination toward delay, according to their public comments and recent interviews. So says the Wall Street Journal. Now, we are inclined to agree, but because behind the scenes there is just too much uncertainty to add the outcome of an interest rate increase to the mix in the pre-election period. Meanwhile, estimates for third quarter GDP remain for growth at just a little over 3%, slightly lower than last week's 3.5% estimate. Meanwhile, elsewhere in the global economy, Brexit has slipped from the front pages of the financial press, which is typical because it is no longer the shiny object that is catching everyone's attention. However, it will take, we think, years before the ultimate impact is to be seen, so we shall have to continue to pay attention to ongoing developments. Now, the latest, according to British Prime Minister Theresa May, is about developing their own British model, so they will not take decisions until they are ready. They will not reveal their hand prematurely and will not provide our running commentary. Well, over a month ago, the Bank of England launched a huge stimulus package in order to mitigate the damage the Brexit vote would have in the UK economy. The package included a 25 basis point cut in the bank rate to 0.25%. Since then, the pound has stabilized, although it is off a little bit over the course of the last week with all the volatility in financial markets. Since then, the Bank of England will announce its latest decision on interest rates on Thursday this week. So last Thursday, the European Central Bank kept rates unchanged and made no changes to its asset purchasing program, while European Central Bank President Mario Draghi talked down expectations for additional bond buying, and this upset financial markets that have come to rely on continued extraordinary monetary stimulus. More on the bond yield curves as we progress through this webinar. In Europe, the sentiment index produced by the Center for European Economic Research registered a below expectations 5.4, but still better than the post-Brexit number of minus 14.7 in July. The Japanese economy expanded at a 0.2% in the second quarter of 2016 compared to an initial estimate of 0%, mainly boosted by increases in private consumption and public investment, while capital expenditure fell much less than expected. In Canada, following a decline in July, employment edged up in August by 26,000, or 1/10 of 1%. The unemployment rate rose also by 1/10 of 1% to 7% as more people joined the labor force. China's economy picked up steam last month, boosted by government infrastructure spending and property sales that are helping to stabilize growth. A slew of data points released today from factory output to retail sales showed rebounding economic activity in August after a wobbly few months. Industrial output rose 6.3% last month from a year earlier, accelerating from 6% in July. Retail sales grew 10.6% last month compared with a 10.2% increase in July, beating a median forecast for a 10.1% rise in August. Well, where do we see all this taking us? Usually we turn to the bond markets because they lead other financial markets. Let's have a look. Well, in a rare move, bonds and stocks moved in correlation following the lack of new stimulus from the European Central Bank, and yield curve steepened, as to say that this was a positive development for the global economy, which is somewhat upside down from what we would suggest. But traders are apt to sell first and think later when it comes to reacting to unexpected news, and that's exactly what happened. Equally in the U.S. Yield curve, it steepened as well, as did the UK curve and the Canadian curve. The Japanese yield curve steepened, but it was led by lower short-term yields. The Bank of Japan will announce its latest interest rate decision next Tuesday. Equity market values, as we look each week, we want to know why we spend so much time looking at earnings. Well, when investors buy stocks, they do buy a stream of future earnings, which go to pay dividends or are reinvested in the company. Now, the price to earnings ratio represents a metric to measure the stock prices relative to their earnings. The 10-year average price to earnings ratio is 14.3 times. The 12-month forward price to earnings ratio is currently at an expensive 17 times, and that difference makes stocks expensive to us. And this year alone, earnings for the year have been revised from an expected rate of growth of 6% at the beginning of the year to a negative 0.4% at this particular time. While S&P 500 stock prices have risen by about 5%. Third quarter earnings are expected to continue the negative growth for a sixth consecutive quarter. So why are stock prices so high? Well, they're less high than they were, but because investors have been taking on greater risk as they chase higher potential returns, opting for better yields from dividends than from safer assets. However, over the past week, we've seen a significant change or a down move in stocks, and as a result, anybody who was buying at higher levels have just lost most of the dividends for the course of a whole year. For us, that's way too much volatility, and we prefer to be significantly more prudent in our investing strategy. What does it all mean? Well, for over a year now, we've taken a cautious and defensive posture to investing. We do monitor a great many metrics that help us to determine where there might be some value, but until we are convinced that there is value, we will remain patient. With increased levels of uncertainty, we are in no hurry to take added risk unless we see reasonable opportunity. But it is clear that we've been able to not only capture growth, but keep it in times of higher volatility. So what is new with our tactical model? Paul, do you have anything to add for us?
Yeah, I'll talk about tactical as well as some fixed income. First of all, tactical, we've been quite busy the last number of days. Obviously, the market's gotten more volatile the past 3 sessions or 4 sessions. So we have trimmed out. As Scott, you said, we've captured some value and some profits. We've done some profit taking. I've been very busy on a couple files. I've mentioned the last couple weeks I'm working on one new file that is put on hold for the last few days. But we have taken some profits, and we're looking at a few new opportunities, but we're going to be a bit more patient here. I think this volatility will continue to pick up. On the fixed income side, we did do some adjusting as well, and you can read the blog I wrote on Friday, I believe, Friday morning. But my overall macro view is that we've seen a little bit of a change in, I kind of termed it peak central bank liquidity. So you can see everyone's probably somewhat aware, as you've shown, Scott, that the bond market is no longer decoupling with the stock market, which leads us to believe, obviously, that central bank liquidity has been responsible for the asset price appreciation in both stocks and bonds and any other assets, to be honest. So we have made some adjustments in fixed income as well. But just in general, I think the way we operate on a fully discretionary basis is a huge advantage to us and our clients at this stage. We are able to do bulk trades extremely quickly and allocate them across our client portfolios. So it's been very beneficial to us. That's it.
Yeah, and as I mentioned right at the beginning, Paul, we do this simultaneously for each client, so everybody gets the same prices, and I think that's also an important thing for everybody to know.
Yes, absolutely. It's almost like running a fund.
Indeed it is. As we do each week, we want to have a look and see what is coming of any particular interest. So as I mentioned earlier, we'll see the Bank of England's interest rate decision on Thursday of this week. We'll also see the latest U.S. retail sales data for August, give us an idea of what the consumer is doing south of the border. On Friday, we'll get a hint of U.S. inflation data, and that's something, of course, that may come into consideration for the U.S. Federal Reserve, although their key target is not released till later in the month. And then next week, we'll start, well, we won't have much until we talk again next week, but then we will also have the Bank of Japan interest rate decision on Tuesday evening next week. And then next week, of course, the U.S. Federal Reserve will make their decisions on Wednesday and announce that at 2 p.m. And that, of course, will be followed very closely by all market participants, so we'll be very much tuned into that. And we'll also see some consumer confidence data in Europe and home sales in the U.S. on Thursday of next week. And then to end next week off, we'll see some inflation data from Canada. Now, a reminder to everybody not to forget our client event, which is coming up on Wednesday, October 5th. Please make sure that you respond and RSP to the e-vite that you received. And remember that it is okay to bring a friend, especially if they might be interested in IROC. We would certainly be pleased to meet them. That's it for today's discussion. If there are any questions, this would be a great time to bring them forward. No questions today?
I have a question.
Okay.
For our wine and cheese event, presumably those who got an invite can bring a spouse or a family member as well, I assume?
Absolutely.
Excellent.
Absolutely. That's a great question. But I think that's all we're going to get from our live listeners today, Paul. So anybody who's listening to the recorded version and has any questions, we would love to receive an email. We certainly also appreciate all the feedback that we get on these calls, and it certainly helps us to determine how we set these calls up and make sure that we're presenting the information that everybody wants to hear. So thank you for that participation. And again, thank you for taking the time out of your busy schedules to tune in. Don't forget to be back next Tuesday, September the 20th. But until then, this is Scott Tomlinson signing off.